Well, I have a significant announcement to make. But before I make that announcement, let me lead into it with a little bit of history. I posted my first CFA video to YouTube on May 15th, 2015. So we're coming up on 7 years that we've been doing this, and our growth has been incredible. All without any advertising, all by word of mouth. And I believe that if you do good work, that is the best form of advertising because people will talk about it. So we've done something right, and we're happy about that. Over the last year, it has become obvious that the pace of our growth was beginning to work against us. We simply couldn't get resources. We had trouble with IT. We had trouble with IT all the way to the end. When I say the end, you'll understand what I mean shortly. And with content creation, I had been through a number of different voices and different people in that space, and none of them were at the caliber that was necessary to produce what we were producing. We simply couldn't find talent on either the content side or the IT side. Over the past few years, we have also had interest from several companies in the financial education industry to be acquired. And we had two criteria. If we were going to go down that road, we had two criteria. The biggest one is, can you solve our resource problem? We have a resource problem with content creation. We have a resource problem with IT. Number two, will you preserve our mission? And our mission has always been from the beginning to deliver overwhelming value, which means we want you walking away from us thinking that you got the better part of the deal. And that comes with accessible pricing so that your access to quality education does not depend upon your wealth. It depends upon your willingness and eagerness to learn. Accessible education. And only one company checked all those boxes. We had a choice, and we had gone down this road with a number of companies, and one company checked all these boxes. And I'm going to introduce you to that company in a second. We are now part of a larger organization. First, though, over the years, I have been asked if I'm going to do FRM. And my answer was, listen, with 3 levels of CFA and me being the only one, here's the morning, here's the night, there's nothing else I can do. I have to sleep. I had no bandwidth to get it done. So I'd always refer our candidates to Bionic Turtle, which was the best in that space. Well, the company that we joined acquired Bionic Turtle about 1.5 years ago. So we are now in the same house. So let's just flip over to their website. I'll introduce you very quickly. There we are. We are now part of Serify. And if you scroll down here, you'll see all of the education programs they offer. Financial accounting, they have a CPA. Financial analysis, CFA, that's us. And you scroll down here a little bit more. Risk management, FRM, there is Bionic Turtle. And after this announcement, after I'm done this introductory part, the back end of this video is me introducing you to Dave Harper, who runs Bionic Turtle. And we're going to have a conversation about a number of things. And we'll introduce the FRM program to you and introduce him to you. And our conversation weaves in and out of a bunch of different topics. So let's get to the more important points, and probably the more important questions you have is what changes for you and what does not change. Here is what changes. I now have resources, especially when it comes to content, which has been a sticking point for many years, is finding qualified people for content. So you're going to begin to see new questions appear in the question bank. You're also going to begin to see walkthrough videos of some of the question bank questions. For those at level 3 who do the AM exam, you know that I have walkthrough videos for the AM exam answers. I have been asked to do walkthrough videos for some of the QBank questions, but again, it's that bandwidth. There was no time. So I have a list of all the nice things that I'd like to do when I get time. I now have time. That list is going to happen. So you're going to see some walkthrough videos of some of the more difficult questions in the question bank. And those walkthroughs will be a mini tutorial, kind of like a nice review. So as you're going through them, it'll combine some elements of review along with some elements of tutoring for the question. You'll begin to see new voices appear in the comment section because we're now internalizing that feature. We have used mentors for the past while. Again, bandwidth, right? The number of questions on the site got to the point where there was just no way for me to handle it alone. So I had to bring some people in. Well, we now have people to do it. So this is going to be great. I now have more time to dedicate towards the things that I really want to do, which is more video. So you're going to start to see new seminars appear across all the levels on difficult topics. I already have some seminars up. I'm sure many of you have come across them. That when there's a difficult topic or when I see questions clustering on a particular concept, I know it's time to do a seminar. Well, I haven't had time really to put those together, so you're going to start to see more seminars. I have a new format for the end of chapter questions because I'm often asked, why is it not A? Why is it not B? So I'm actually going to fill the end of chapter questions as I redo them. I'm going to fill them with the exact references in the reading of where you can find the answer to why it's not A and why it's not B and why the answer is C. I'm also going to collapse a lot of the review into the end of chapter questions as well because I find it flows a lot better if you squeeze the two together. Always been an idea I've had, never had time to do it. Now I do. And you're going to see more applied videos as well. I do the weekly market updates, which many people find useful. But there are a lot of other applied videos I can do about particular concepts. How does this apply in the real world? When am I ever going to use this? And I've been saying for quite some time that I don't think you can find a better collection of content for the market that is both academic and practical at the same time. So if you lack the practical experience, you get the academic side. Everything may seem a little too academic. I'm going to tie as much of it as I can to the real world, which helps you understand the concept a little bit better. So that is what you're going to see change. What is not going to change is your experience. Pricing will remain accessible. That was a key thing for me. One option we had was a decent enough option, but we knew pricing was almost going to double overnight. We knew it was going to happen, and that was the big stumbling block on that one is, look, we just can't do this. You know, we have a responsibility to everyone that we said, here is what we do. This is what we're in business to deliver. Here is our mission. And then to abandon that overnight didn't seem like it made a lot of sense. So we said, let's just keep trying to solve our own problem. Our pricing will remain accessible. Now, back in December, I had put up a video talking about our pricing for 2023, and I did at that time telegraph that we were going to have a price increase. We weren't sure how much it was going to be. We were trying to lower our costs as much as possible because, surprise, surprise, prices are going up everywhere. Amazon wants more money from us. Our landlords want more money from us from rent. Staff needed more money because, well, inflation is going up and every year your staff is more and more valuable. You got to pay them more. So we had price increases as well. So we knew that we had to pass on some price increases because our pricing is based on cost plus, not value-based pricing where we say, we think we're worth $2,000 to you, so that's what you're going to pay. We say, look, knowledge is free, but it costs money to deliver, costs us this much, let's go to here. Well, now it costs us this much. So we had telegraphed a price increase already. So in June, when you see the 2023 pricing, it's not going to be that much more. It's not like we're doubling our price or raising it 100 or 150. It's not going to be like that at all. What I don't want to hear is, oh, well, there goes the pricing. We had already decided on it. We already talked to the other side before we even went down this road. We said, look, this is very important to us. We are increasing our price this much at this point in time. Do you agree? And they said yes, they would honor that, they would agree with that, and that was it. That was all that we needed. What you may notice at some point in the future is our Canadian pricing turning to US pricing, but at the exchange rate. So if we have something that's 100 Canadian, it's not suddenly going to be 100 US. It'll be, well, what is the US version of $100? It's this much US, that will be the price. And that is one part of our business above all that we needed preserved. What would be the point of tripling our price and cutting our market in more than half and leaving some people on the outside? It couldn't happen. Well, we have it all. Anyways, that's the big announcement. I'll have more to say about it as time goes on. But we are now part of Serify. We're still Mark Meldrum. The company's still markmeldrum.com, a Serify company. And we are sitting right next door to Bionic Turtle. We're in the same tent, under the same umbrella, I guess however you want to say it. So, for the rest of the video, enjoy a conversation between David Harper of Bionic Turtle and me. Yeah, it is. It's done. We are now married. So you and I are, living in the same building now. We're neighbors.
Well, I don't want to see that much of you.
In that, you don't want to see that much of me, eh? So here I am now. The other day I was, we were talking about something, and I was talking about the pace of change of content. Actually, while we're doing this, it gives me a good opportunity to get your opinion on a number of things. CFA is known for changes every year. The pace of change sometimes, especially at level 3 over the last 3-4 years, has been relentless. So you end up praying every year for just a break in something. Is it the same with FRM? Do you have that pace of change? I would seem to think, because it's risk management, and in CFA we learn that expected returns can be all sorts of things from year to year, but correlations and volatility tend to be more stable, and because it's risk management, you would think that there'd be less changes from year to year. Are you faced with a lot?
Yeah, you might think. Yes, we are. I do have the same problem, and it's a sense of dread every year when the association releases our association is GARP, Global Association of Risk Professionals. There's a little bit of anxiety around how many changes are we going to get, how big are they, and the average, I call that churn. So the average long-term churn is 30% per year. So I do consider that pretty significant. We got spelled this last season. They did modest changes. But if it's more typical, when we get round about to the next 2023 cycle, and we'll get like the other prep providers, we'll get the changes in. We get several months in advance. We can actually give input. And I used to be very active on the input side, but it's I'd quantified it as roughly 30%, sometimes 40%. And the reason maybe it's not quite what you expect there is, it's 2 parts. The FRM is 2 parts, unlike the CFA being 3 levels. And the part 1 is tools. And the basic tools are more stable to the examples you just gave, right? Portfolio correlation does not, the content of that does not change year to year. The reason it isn't experienced that way is that the FRM it's an anthology. They assign chapters out of textbooks. Until recently, this is just part 1. They now brought that in-house for the first time in 20 years. They brought it in-house, but if you take like our derivatives, which is very similar to the CFAs, the high overlap with the CFA derivatives, the previously assigned author was John Hull, Options, Futures, and Other Derivatives.
Yeah.
And when they brought it in-house, they hired John Hull to write, to be the primary author on it. So on the part one that was stable, let's take econometrics as a great example. The fundamentals of econometrics, statistics, probability, time series, the fundamentals have not changed since I've been teaching them, really. But what they would do is they would swap the author.
Oh,
right?
okay, right.
You have Hergerati, and then you'd just go to literally 5 different authors on the econometrics in a span of 8 years. And as the candidates coming in they don't understand the inside baseball of it. To them, it's the author. And in fact, a lot of times, well, that is, you do have to do the work to do the update. And as if you go out and take a concept, you take a definition like alpha or information ratio or tracking error. There is, depending on the author, in a strict technical sense, you can get different definitions. So this rotation of the authors around what should have been stable concepts, is a big part of is why part one, was too frenetic. And then part two, like up around part one is the tools, part two is the applications, right? So you learn the tools, and then you go into market risk, credit risk, operational risk. They've recently added liquidity and treasury, broke that out, investment risk, and then current issues, specific topic application. Those have always been, rotated with authors, and just like over rotated in a way that's painful for the prep providers. A mixed blessing, the only thing about, in my case, is, we use it to our advantages. We worked hard and we're able to come out quicker than some of our competitors. But yeah.
So when I looked at it quite a few years ago, you're right. It was a reading list, and you had to assemble a bunch of textbooks. They did have a sort of compilation, but it wasn't very good. It was, short. It didn't have a lot of examples or explanatory notes to it, that if you didn't already know what you were reading, you wouldn't understand what you were reading. So you had to go to the source as much as you can. With CFA, they've always given you the readings. They've always had their authors. They've given you the readings. Everything was self-contained in the candidate body of knowledge. You just said that GARP is moving towards doing that. Have they implemented it across the board, or is it just they're just starting to bring that in now?
Part one has their own GARP readings, although part one they brought in-house to their they have done that. Part two, they're a long way from doing that in part two. It's just it would take a lot of resource to do that. Part two is still that reading list. And then part one, I'm not saying anything that I haven't said on the forum. The new readings are for the most part, is not as good as what they've replaced. So you take like derivatives, and really, if the candidates, a lot of the candidates should just go back to using John Hull rather than the new. If there's a very simple reason for that. I think they thought that shorter readings would make it just more accessible, but a lot of what they took out is illustrated examples.
Yeah, and you need that, especially over in derivatives, anything quantitative based. If you don't have a lot of those illustrative examples, because abstract writing doesn't get you there.
Right.
When they're just describing it abstractly, is you need some kind of concrete example to get that done. And that's been the experience over with CFA as well. They've been replacing tried and true authors from a publisher that has 100 years of editing experience, and they've been bringing it in-house. And the number of mistakes that are being made simply because they haven't got 100 years of editing expertise behind them. So they don't have that process in place of how do you get all of this edited. The textbook publishers, and when I was an academic, this was quite common, where you would receive a chapter and asked if you want to review it, and you would review it because they would then make a donation to your research budget. But then you'd have to review the reading. So they had this network of academics where they would send out chapters of textbooks to, and they'd come back with all the edits, the suggestions, maybe say it this way, you're missing this part, you're missing that. When you decide to bring it in-house like GARP has done, you lose that network. You lose that whole editing process of corrections, getting them caught, and also feedback on how to improve or how to get your message across in a less abstract way. So I don't know that it's such a great idea to say, let's bring all of our IP in-house, unless you have that 100-year history of editing, and you can get that done, because learning the wrong thing is frustrated when you can't recognize that it's wrong because you don't know it yet.
Yeah, that's exactly right. And then it's compounded by the fact that the end of chapter questions in the assigned readings are not representative at all. They're merely like to tease some basic understanding, so you don't get any exam representative questions. And the other thing about the reading list approach that we're talking about is that you don't necessarily get the scaffolding. You may
Yeah.
we have the Grenold reading assigned for portfolio attribution, which can get pretty advanced. And then for most of the GARP in part 2, it's two of the chapters out of that book have assigned. And really, the portfolio attribution, you really need to read the whole book to get the scaffolding in order to understand what they're talking about, including, for example, like notation. In quantitative finance, notation can really get you stuck.
Yeah, and every author seems to want to introduce their own different version of notation. I've seen the same variable. For instance, strike price, I've seen it called K, I've seen it called X, and it depends on the author, and you can't just jump into a textbook in the middle with another author, because you're left with, well, what does this variable mean and what is that? Shouldn't this be this and shouldn't it be that? So I've seen it, when you get used to a particular author, you're used to a particular notation, the first thing you have to do is decode that author's notation, because they break with the industry sometimes and they decide, no, I'm gonna do it my own way. I'm gonna use a different notation because in their language K stands for something else, so I'm gonna use X, whereas this author says, but I use X a lot over here, so I got to use K. So when you go through Hall, strike price is K. When you go through other authors, strike price is X. And you have to, when you're teaching that and you have to jump from one author to another author, you also have to put up the exchange rate, and say, well, okay, this is now this and this is now this, but these things here mean the same thing. You might see it as little v, you might see it as big V, you might see it as F, or you might see it as phi. So that can become extremely frustrating. For our CFA candidates who want to take level 1, would you suggest that they would be better to take level 1 FRM after level 1 CFA because it will help them with level 2 CFA, or they should take the level 1 FRM after level 2 CFA because that will help them with level 1 FRM? I think it's like once you're done level 2, you basically got 75% of level 1 done.
Once you're done level 2 of CFA?
Yeah.
Yeah, I'm not sure. I think it's sort of, if I'm a candidate, CFA has its own, style and rigor, and FRM is different. If I was a candidate, I might prefer to do one, then the other. I know that we do see people doing both of them, and you do have the question about which one to start with. I am rusty on the CFA. I just experience them as very different. It's a little change of subject, but I was looking at the refresher readings last night, and they're just so they're just really good on the CFA side. The rigor that goes into it, and yeah. So I don't really have a view on that. I Except that the FR the FRM has its own style. There's just there's a lot of tracking error in the what I call tracking error in the exam. A lot of candidates come in and they want to know what to expect. And I would call like low tracking error or prospective clarity with the exam. That is like low tracking error would be the exam that we can tell you now with good precision or accuracy what you're going to see on the exam. And it's really not the case in the FRM. And some of it is just like large number law. The part one is 100 questions, multiple choice, 4 item set. Part two is 80. So you have a total of 180 questions. But then you have, I don't know, 1,500 learning outcomes, and some of those are compound. And so, just mathematically, the exam that you take, I don't know if you experience the CFA, but the exam that you take, by definition, has to be a small window on what you're asked to prepare for. And, that combined with the sort of looseness and sometimes casual style on the learning objectives is a real challenge to give them low tracking or perspective clarity. I have a memo on my. It finally culminated for me. I wrote. I took a week and wrote a memo called "How to Fix the FRM." Sent it to the GARP and the trustees, and I just accumulated all of the sort of evidence and feedback for them that we got in our forum over the recent years, just to identify some of the problems and suggestions. I think I think of myself as sort of an activist investor with the association, trying to improve it, because we would just get after the exam we get a lot of feedback, and every year some of these questions have to be appealed, and one of the most frustrating parts about it is I think when you don't have the rigor in some of these definitions, some of these questions are harder for a candidate who's more well prepared.
Yes, absolutely. I'll agree with you there. I'm seeing the same thing with the CFA questions, the end of chapter questions, that if you know a little too much, you recognize that the question is flawed. It doesn't help you to prepare for an exam that may have questions that if you were too smart, you'd get wrong, because you have to answer them within the limited knowledge that the author had when the author wrote the reading, and you can't say, but I know more. Well, you won't be tested on what you know, you'll be tested on what this author knows, and this author doesn't know that. So you can't know that going in, otherwise you'd recognize. I'm seeing this in some of the end of chapter questions where you read them, you go, this is a flawed question. But if I limit my knowledge to only what's written in the reading, then I will come up with this correct answer within a wrong question. That is extremely frustrating.
That's too much cognitive load on the learners. We're trying to help them with mastery. Yeah. It's the burden of a question. This is my favorite topic because writing practice questions is my core advantage. But it's the burden of the question to be clear and to provide all the assumptions and to explicate anything and to not load on too much, but certainly not to penalize candidates who know too much. My favorite examples from the early years, you might find this funny. We would if the question said this coupon bond is 10 years, you're just supposed to assume the modified duration is 7 years.
Just a short rule of thumb on that.
Yeah. Even a quantitative answer. Then we had to write them in, way to provide feedback and say, a lot of our customers know that duration is variant to coupon. Mm-hmm. So, could you not do that?
Yeah. There was a couple years back at level 3, there was just a rule of thumb that on swaps, the fixed rate was 0.75% of the term. Regardless of the steepness of the swap curve, you just assume that it was 0.75. So you end up writing questions with that limitation in there. And then when they change the readings, those questions still survive as words you get 0.75 from. It's like, well, it was a limitation of another author, and you got to remove that. But yeah, right. We're seeing the same thing on the CFA side, which Do you have an opinion on these pass rates for CFA? If you've seen level one, we're down to like level two and three have somewhat recovered, but level one, the last pass rate was still 27%. To me, that seems just illogical that you would expect a large population of motivated, otherwise intelligent people who would suddenly have a 73% fail rate. You know, do you have an opinion on that?
Well, I've had some interesting discussions. As you know, there's some cynical interpretations. Some people think it's frankly, a business reaction to the pandemic hit. I've talked to some folks at CFA, and I happen to personally be persuaded that by what I was told, that this is an outcome of the Angoff approach that is used at CFA. I mean, stepping back for anyone who's listening, this is sort of interesting. I do believe what I'm told, that the CFA basically manages to a standard, and technically that's called modified Angoff. I think there's a lot of play in what the modified means there, but basically that means you go out to experts and you say, a pool of experts, you look at the questions, they rate it 0 to 100, and the critical thing there for the Angoff is the definition of what is a minimally competent candidate. So they say, Mark, you write a question, I'm the expert, and I say, I think 40% of the minimally competent candidates should get that correct. And as far as I understand, there's a lot in the modified, but then you really roll that up to the average as the cutoff. So if you've written a bunch of hard questions, I'm going to say 20%, I'm going to say 20%, 40%, the cutoff is going to be lower, but it's going to be based on a standard. I am persuaded by what I heard on that. And then here's what some people don't believe when I tell them, and that is that the FRM grades on a curve. So you may have noticed, and as I was assuring everybody at the time after seeing your first plunge in part one, our candidates were saying, do you think they'll do that to us? And I said, no, because GARP manages on a curve. So our part one long-term average pass rate is about 46%, and our part two long-term average pass rate is about 57%, and it's plus or minus pretty tight, and that's because they go after the exam. They're not going to let that happen, and there's a lot. There's a pros and cons about there, but there's some obvious cons to managing on a curve.
Yeah, if everyone does poorly, if the group does poorly, you still get the same pass rates. So when somebody has an FRM, you now have to say, well, what vintage FRM are you? Was it the year in which everyone did poorly because, or was it the year that everyone did well? So yeah, there's a lot going on with this CFA pass rate and a lot of different stories. I get the Institute's story, and I think that there is something there, but I think there's more. You talked about they told me they broke out the pandemic cohort or the deferreds. Yeah,
and that.
They did find that significance between the two, that there was, because how else could you say that it was that unless you obviously have the data. It's what I would have done. I would have broken it out, and if I would have seen the mean shift to one end, I would have thought, well, okay, right, there's something there. I think that it's a variable in the regression, but I think there are more variables in that regression as well. I think it has to do, there's something to do with fewer questions being asked, but not fewer pages of content associated with it. You were saying that, you have 80 questions and you have this big body of knowledge and you have to try to get 80 questions in there. They've gone from 240 to 180 questions. Without taking the amount of content and shrinking it likewise, or moving it up to higher level themes. So now it's instead of one question for every 10 pages, you have one question for every 13.3 pages, all on one question. So it becomes riskier. Each question becomes riskier in the sense. And anecdotally, you hear on Reddit that some of the questions dive into this small, tiny detail that you wouldn't, based on what the learning objective is and what the question is, it's so outside or so at the edge of the learning objective that you would think, but that's not, being that you only have 180 questions and you have something like 550 learning objectives, that you would hit those big themes along the way as opposed to small little detail.
Right.
So we do see this in the end of chapter questions, that sometimes you'll get to an end of chapter question, you think, but it's either, the ones that upset me the most are the ones that are a word riddle, where you first of all have to figure out what the riddle is, and it's just a word trick that you got to get, or it dives into this tiny little detail that you would think, but that's not in the spirit of the learning objective. I would, if this were me, I'd be crying foul saying, wait a minute here, this is way outside of the learning objective. So I think that there are some, when you compound all those little variables, I don't think one variable leads to a big outcome. I think it's a combination of a whole bunch of variables all together that lead to that outcome. But is the weighting on the pandemic significant, on the pandemic variable significant? I'm sure it is. But what other missing variables should be in that regression that weren't in that regression to help explain that? So I think it's a little bit more than one thing, but I think they're trying to also figure it out at the same time,
right,
about what's going on there. So off topic here. What do you think of this? I know that your positioning in the market is more tech heavy than me. I think like Donnie and Marie, you're a little bit NASDAQ, I'm a little bit S&P. What do you think of this recent rally? What do you make of that?
Yeah, I don't know. Yesterday I listened to your last market update. Just amazing. I have so many questions to ask you about. I didn't know what I was missing out on, because you talked about the inverted yield curve, which I think everyone's been talking about. Yeah, I think my hunch is it's just a rally because these fundamental concerns are still here. The Fed, inflation. I mean, inflation has not been transitory. The Fed is going to do six hikes, as you said, maybe up to another 250 basis points. So one of the banks have thought that. So we have the war, which is inflationary. We have basically the telltale signs of the late stage of an economic slowdown. But where to go? Tina, there is no alternative.
Yeah.
And which is I'm limited by my skill set, which is I like, I invest my equities, or my equity allocation is equities. So I don't get out of stocks. I just, I'm in a group on Seeking Alpha, and, I think the first thing that I would say about myself as an investor is that I am a qualified part-time investor, right? I would do things differently if I were full-time. I'm a part-time investor, so I think the most important determinant of my performance long-term is the information filter, right? Who am I curating and listening to, and how am I filtering out the noise? So in October, November, because I follow smarter people than me on macro, I could see that inflation was being a problem, and my style has been growth. I basically think the market, if you're in the stock market, you buy growth is the way to maximize returns. And so I was in a group of high growth, and I just thought, we were having an argument. I was just saying, following smarter people than me, I was just saying, this inflation is going to be a problem. The Fed's going to have to react, and a lot of these stocks are going to get hit. And it just became clear to me that I was talking to a lot of people on investors there that did not have a sense of history, just the confidence that no, we just grow, we just buy growth, we'll grow out of it. I do think there's something to that, but I think my decision to shift in November was correct in the sense that where you didn't want to be was in unprofitable growth, right? If you think about discounted cash flow of a business, it's a simpler model to discount a profitable company than it is to say, what's an unprofitable company worth in discounted cash flow? It arguably is worth zero, unless you have to have a very compelling story about the path to profitability and when it turns. So yeah, I sidestepped some of that, but I'm still in equity, and I'm doing what I think is a classic strategy. It's like I'm really just checking everything for quality.
Yeah, I think that's all you can do. This week we're having our conversation before I put up my market update. I worked on it this morning, and then I got the other half to do this afternoon. But what I'm doing over 2 weeks is, whenever I'm troubled by something, I try to make the other case. So if something is not going up that I think should go up, I will then do the very best I can to make the bear case. And if I can't make the bear case, there's no bear case to make, which means I'm right. But if I can make a bear case, then I have to start saying, okay, well, how do I lay off some of the risk that I currently have? What part of the distribution do I want to get rid of? So this week I'm going to make the bull case for equities. Which means you've got to make a bull case for GDP growth if you're going to make a bull case for equities. So that's what I'm going to work on this week. And there is quite a lot to make a bull case out of. But for every point that I can make a bull case out of, I know next week I've got a point that I can make a bear case out of. There is just as much compelling data out there to make a bear case with as there is to make a bull case with. So it's, I'm at that particular point where I think, I'm giving equal probability to going either way at this point in time. So my bias on the market now is sideways. At least if I were in charge, I'd say, well, I see no reason to go higher, but I see no real reason to go lower. So I think that we're in some kind of noisy range for a period of time. But I'm not in charge of the market. I looked at fund flows for the past 7 weeks, and it's amazing the amount of money flowing out of global bonds. And if you follow the primary rule of institutions, money has to go somewhere. It doesn't it can't just sit over there. Money has to go somewhere. And you start.
Let me guess, U.S. equities.
Well, you know what? If you look at the last week's inflation data for the Eurozone, it's actually worse than the U.S., especially their PPI, far worse than the U.S. And I think they got a lot more growth problems ahead of them being proximate to that war than the U.S. has. The U.S. has the S&P 500 is a U.S.-based, U.S. domiciled, U.S. legislated global index because all those companies are global. So you're actually getting a global index with a very American flavor to it in terms of the way that they manage business, the way they manage risk, the way they think about growth. And a lot of the S&P 500 businesses, something like 40 to 50% of their labor costs are external to the U.S., where they are getting no wage pressure whatsoever. So that was an interesting statistic is, yeah, you got a lot of wage pressure, but it really is more of an American, I'd say almost a North American phenomena. You're not really seeing this in other parts of the world. So I think that the S&P could weather this. When I look at other measures of the consumer seems absolutely willing to spend every single penny they make the moment they get that penny. Absolutely willing to spend every penny they make. So as long as you keep feeding them credit, they'll keep spending. So, I think the biggest gauge right now for the health of consumer is growth in consumer credit. As soon as you see that kind of roll over, then you would say, well, where are they going to get the money to spend? They are more than willing to spend on that credit card, more than willing to live paycheck to paycheck, more than willing to have stuff because, well, I got to have more stuff than you. I have to buy stuff that I want you to see me with. The only reason to have stuff is for other people to see me with this stuff and be jealous. If you're not jealous of my stuff, I'm buying the wrong stuff. I got to go get other stuff. And it's, I think that is a very North American culture. One thing that I found really, really interesting between Europe and North America were two things. Europe doesn't have suburbs like North America has suburbs. Europe doesn't have house sizes like we have house sizes. And one thing you don't find a lot of in Europe are storage facilities because they don't have stuff to store.
Oh, like the rent storage facility.
Yeah, you don't have storage facilities, whereas in North America, not only do we fill our house with stuff, but when we have too much stuff, we then rent a storage locker to put stuff in. Whereas in Europe, you don't really have the size of the storage industry is nothing compared to what it is in the U.S. That tells you a lot about who drives growth where. In Germany, I think the consumer makes up only 50% of GDP, whereas here it's anywhere from 65 to 75, depending on the amount of credit that you can create. So it makes it easier in North America to figure out what's going on. All you got to do is figure out, well, what's going on with the consumer? Where are they getting their cash flow and where are they getting their credit from? And if those two spigots are turned on, we're good. You never have to question government's willingness to spend in North America. You just have to question whether or not they'll have any kind of constraint whatsoever, but you never have to question their willingness to spend. They're going to spend. So the G in GDP, the CIG and exports, the G is just a given. It's just really the C and the I that you have to worry about, and I see no problem with the C at this point. But anyways, I'm giving way too much away.
I can't wait. Yeah, well, we can print more money. I'm just curious, speaking of home builders, because I have some home builders. You mentioned house
not doing well, are they?
Well, not recently. But I have a longer horizon. So I'm sitting on gains on all my home builders, and I think they're fabulous value currently, even though they're not. But do you think against that test of consumers? Do you think it seems to me home builders are a good way to look at it? Maybe a bellwether there. The consumer in the home building market is the biggest. This is obviously the biggest purchase. That is continues to hit on all cylinders, and we seem to be far from an affordability problem there. With the median house price here just broke 400,000. Just looking at housing,
that's cheap.
We don't see it.
That is super cheap. The median home price at 400,000. That's cheap. I think the mean's quite a bit higher. Yeah. It is much higher here. I bought my house for a certain number 3 years ago. I can sell it now for twice what I paid only 3 years later. A little more than twice what I paid based on what's going on in the neighborhood. That used to be a 15, 20 year, 25 year holding period. You're getting those in 3 years. When you start going parabolic like that, look, it's gravity, right? That cannot unless wages start going parabolic as well, that can't hold. So I think, with the higher mortgage rates, you have seen mortgage applications fall off. Now, mortgage applications can fall off because refinancing disappears. You're not going to refinance at a higher rate. So you could say, well, refinancing is gone. That can explain most of the drop in mortgage applications. So you got to really look at home sales to really get the idea of, well, is it people buying homes that are falling off, or is it just the refinancing? You would expect that prepayments would decrease as rates increase. That's mortgage-backed security 101. And you are seeing a drop in home sales, in new home sales and existing home sales. There's only one variable to look at, which is the fixed rate mortgage. And week over week, it's down. It went from 4.95 down to 4.88 because all yields kind of dropped off, break evens dropped off. So what I find is going on in the market today versus 20 years ago is, if the market expects something to happen over the course of the year, they get there next week. You know, rates, you know, the front end of the curve is going to lift 200 basis points. Well, let's just put it in the 2-year right now. So you got a 2.5% 2-year. Let's just do it now. Let's just put it in now. So you don't have this opportunity over time to build any position that if you have an idea where the market is going, you better get on board right now because it wants to get there tomorrow.
Oh, absolutely. Impatient on that.
Yeah. So sure, the Fed is probably going to raise rates 150 more basis points this year if we believe what the Fed wrote. But it's already in the 2-year. It's already there. We've already gotten there. So I don't know that we're going to go another 100 basis points up. I think mortgage rates just sitting below 5% got there immediately from where they used to be. They got there immediately saying, well, if we're going to get there, let's get there tomorrow. Why wait all year? Let's get there tomorrow. And now that they're there, it's like, well, what do we do for the rest of the year? We've priced everything in, and that's where it starts to come back down a little bit, because it's like, well, you know, price always leads fundamentals. Price always leads fundamentals. But the idea now is price is not just leading fundamentals, price is warping to where it needs to be in an instant and saying, okay, well, come on. Now price is sort of going back to say, okay, well, I guess the fundamentals aren't moving as fast as we would like. Let's relax. But I've noticed in the last 3-4 years, 5 years now, that if you believe that something $20 should be $40, and if the market also believes it's $40, it doesn't wait to get to $40. It simply just gaps to $40, and that's it. So you pretty much got to get on board. I think rates have front-end loaded pretty much everything the Fed wants to do this year. I think it's all in. So I think you're going to have I think volatility in the yield curve is going to drop, and I think it'll do this kind of thing for the next couple of weeks. But I think that these big things are gone in the yield curve because, well, we got there. How much more do you want the 2-year to go, right? Right. So it's this instant market. I guess it's a culture thing, you know. In the U.S., there's all this, you know. I shouldn't just say U.S., but North America we're in instant. Everything is instant, you know. If we have to wait 4 seconds for a web page to load, we lose our patience. You know, we want everything to happen and everything to happen now, and I don't want to wait around anymore, and let's get it done. And money moves so fast these days that I think that if you have this price target in your head and the market has a price target, it's why take the long road there? Why take the scenic route? Let's just fly there right now.
Can I give you my answer to that? Mm-hmm. Because tomorrow, literally tomorrow, the market will change its mind and go back in the other direction. So my favorite example, you know, I own Upstart, and they are disrupting the FICO score, right? But they're applying machine learning to the traditional underwriting, and then so the talented analysts, they are very talented analysts following that company at Morgan Stanley. But I'd shared with our company internally in our Slack the fact that you know, in the span of less than 60 days, they dropped the price target 55%.
The analysts that follow it.
Yeah, Morgan Stanley has
Morgan Stanley's downgrading everything.
Yeah. So these price objectives, you know, they're sort of like lagging indicators. They follow the price, mm-hmm. and then one day a 55% drop in the price objective, without really, you know, the external factors, without really fundamental justification for it. And then on the next report, you know, another backup about recouping about 30% of that with the new news. So the reason that I feel like that's a losing game for me as a part-time retail, a retail part-time investor is, yes, they will all go there, but what matters is the fundamental of the company. So they'll go back next month back to where we were originally. So why get caught up on that? I feel like as a part-time retail investor, my only real source of any alpha would just be patience.
Yeah, and I think that is probably one of the most underrated things. There should be a chapter in almost every investment book about patience and how to get patience. A lot of people can't live with that kind of volatility because I think that they check in way too often. Or they have their screen open all day long and they're watching every tick, and all that noise sounds like information at the time that they don't have the patience to sit back and say, I have my thesis, nothing has changed, I'm going to stay where I am. It's hard to do that, especially for more inexperienced people. It's hard to stay on a bucking horse. I mean, it's easy when there's low volatility and everything is predictable and the market adds 0.2 or 0.4 per day and maybe pulls back 0.1 and adds 0.2. But when you have these greater than 1% moves up 3-4 days in a row, followed by these moves down, followed by these moves up, by these moves down, and all of this this idea of we got to get to the price target right now, because what's the point of having a price target if you're not going to get there? That kind of volatility is unsettling, I think, for a lot of people. That it's hard to stay in the game when you have that much volatility. So patience, no, I think you're right. You want the best risk management technique out there. Patience. Patience is one of the best risk management techniques that I've learned over the years. Is if nothing has changed with your fundamental story, the market will do all sorts of things. It's just, let's just have some patience. Let's just wait and see what happens.
Yeah, because I feel like in the short run, a lot of what's going on with my companies is guilt by association. Like the home builders, they move as a group. And if Lennar really is different, you're going to have to wait to find that out over several quarters. But or like SPACs, it's all, I think there are some good SPACs out there, but forget it. If there's no time, it's make a quick judgment over. They're all bad. Avoid them. Mm-hmm. So I actually think that volatility creates some opportunities. But you're right about like these 2% days are just, I don't have the stomach for it.
Yeah, one of the things that this new association our company has with the larger group, Serify, is it now gives me more time to produce more content that brings the content much closer to the market. I've always had a problem with time. Time was the one resource I just never had in any kind of abundance. I mean, this was my day. This is waking up. This is going to bed, and there's nothing you can do to lengthen that. Everything had to fit within that amount of time. This opportunity adds for us adds some writers, so that I don't have to spend that much time with the question bank, with the mock exams, because now we have some very experienced writers coming in that were just brutally difficult to find before. And there's a lot of stuff.
Can I ask you some questions? Because Mark, we spent too long getting around to you. I'm sorry, but can I ask you some questions about that?
Yeah. Go ahead. Let's flip it around. Utah, you ask me now.
People want to. It's a rare chance for me to ask you questions, because I did have that. That was one of my my first question was going to be what your doctorate is in, because I should know that, but I don't. But then I also was going to ask you about the key to your success, because I know of two reasons, but the one reason for the key to your success is you appear to have an unearthly work ethic. You you put a lot of time into it. I think it looks like your applied market series are coming out on Sunday. I don't know when you record. You do these this last one I saw, it's like an hour or longer, and amazing. It would take me so long to prepare a video that to even get close to that kind of quality. So just by your output, I know that your work ethic is off the charts. But yeah, that was my first question. What do you think? What do you attribute your success to, in addition to your work ethic?
Probably the two big things is not married, no kids. I mean, because that is, and I'm not saying it in a bragging way. I'm saying it as in just a factual way that anybody out there with family understands that there is a block of time that is non-negotiable. Where you can't just simply ignore them for 12 hours a day and lock yourself in a room. You have obligations that you have to do. So right away, you're going to lose bandwidth. Immediately lose bandwidth. I don't drink. I don't do drugs of any kind whatsoever. I live a fairly clean life, so I never have to spend half the Saturday on the couch moaning because Friday was a little too much. I don't go out to clubs or anything like that, so I don't have that particular time. I don't view it as work. It's not really work when you have to be pulled away from it as opposed to pushed to it. As soon as you feel yourself having to push yourself to get something done, well, now this is work. But it's more about pulling me away from it and getting me to do other things that sort of make it seem like work. So for me, it's not work. And the weekly updates that I do, all in, is about 8 hours, because it's 4 hours of reviewing the week. What economic data came out? What ideas do I have? Maybe I'm reading something and I see something about something. I think, well, let me follow this line of thinking. Let me look at a few charts, and I use Fred a lot for that. So I'll look at a few things and I'll see, well, is there a story to be told here? And in the end, it's not a matter of what I don't want to do is 1 hour of I think, and that people are tuning in to see what Mark thinks. It has to be about, here's a way to think about the market that may help you. Here's where you find this resource. Here's where you find that resource. Here's how we would think about, the consumer. Here's how we would think about business investment. So as long as it stays true to the word applied, I'm taking the stuff in the readings and I'm applying it to the market. I'm not really putting myself out there saying, I'm a macro researcher that has a monopoly on the truth, so you need to listen to my opinion. It is really just a lot of, if you can watch it once a week and learn one thing that you can use as a retail investor, because there is nothing for the retail investor. CFA really is targeted to an institutional audience. It's not a retail audience. There is no requirement to be a retail investor other than the ability to open up a personal account, and you are then free to play in one of the most shark-infested waters there are on this planet. If the worst thing I think that can happen to you when you open an account is you start making money because you think you're smart, you think you've got it all figured out, and you may just be riding a wave. And when that wave crashes, so will you. Most retail traders lose their money. Most lose their money in 90 days to 6 months, and then they go away. They lose their money. But there's, other than a collection of YouTube videos here and there, and some good channels and some not good channels, when you're a retail investor, you don't know what's true. You don't know what's good. I mean, anybody can sound intelligent when you don't know something on a topic. So that's why I do these weekly updates. It's not so much about saying that I'm right or this, but explaining, well, how do I come to my thinking? What data do I use? And if you find it useful, here are the sources of all the data. You may have a different interpretation. Off you go. But 4 hours is really just reviewing stuff, and then I think about, well, what's the theme this week? What can I tell you that you didn't know before? And that's really about it. It's not a matter of me saying, here are 5 stocks that are on my conviction list that are flashing buy signals, and you should go ahead and buy. It's more about, what supports a particular point of view or a particular outlook. And in the last, since the pandemic, I had more time to start putting out these kind of videos. That most of the calls were fairly correct. Not 100% correct. Nobody has a 100% record, but I reviewed a lot of the calls I made, and they were mostly correct. The one that I'm very, very happy about is Beyond Meat. When it was in the 150s, 160s, I was saying this is a $15, $20 stock. And of course, all the millennials piled on, oh, Boomer doesn't get it, Boomer doesn't get it. And well, looks like Boomer got it, right? I don't hear them anymore, but it's sub $50, and I think the last price target on it was a week and a half ago. I forgot who put the price target on it. It was a significant firm put a $29 price target on it, which I thought was still a little too high. And it's fun to do that kind of thing. I do it all week long, so to do it on the weekends isn't a big deal. For a while, time became very, very hard for me because I did try to do everything. We answer questions on the site when candidates have questions, and I would try to answer them all. And I did that, up until a couple of years ago, where there was just no time. We had grown so big, so fast, that it was crushing me. The weight of the size was crushing me. And I knew going forward that the growth was going to outstrip our resources. That unless I made some kind of significant move, that it was going to become a problem. Because we were thinking about, we can't find the resources. We're going to have to start limiting what we do. Maybe we're not going to be everything to everybody, but we're going to just be this, or we're just going to be that. And that's when I started seriously thinking about aligning ourselves with a larger company, because we can't get resources, but they can, because they're bigger. You get to a certain size, you have gravity. People, you can draw in resources that a smaller firm simply can't draw in. Somebody is far more willing to work for Serify than they are to work for markmeldrum.com, because it has 200 to 300 people. We've got 11. So there's a big difference between the two, and there's a lot more upward mobility in a larger organization. So we had our choice. It wasn't just Serify. We had 2 other companies that we could have aligned with that were very interested in us. But when you look at the resources that you would have had, when you look at who you would have been aligned with, the solution was super, super simple, and it was your association with Serify that did it. And I thought, if you're there, you've done your due diligence. You probably thought it through very clearly, and you are in FRM space what we are in CFA space. You are a lone individual, or you were a lone individual that really was at the top of the game. And if you're going to go to the next level, you're going to have the backing of a larger company that has resources. Because as a small independent, it is hard to attract those resources. Because the bigger ones get the resources, and they don't always deserve the good resources, and they don't always cultivate the good resources, but they're just bigger. So there's this idea that there's more safety and security with the bigger ones. Out of the ones that we had a choice with, it wasn't much thinking beyond that. It was like, well, there's where we're going. Just plain and simple. There's where we're going.
That's so kind to hear, because the highest compliment I've ever received is to be told that I'm the Mark Meldrum of FRM.
Oh,
so, I was like, I've got that bookmarked, and you're right. I think we might have talked about this. It's really, the problem you're talking about is really acute in technology. It's like I think about my history. My pain was all in the technical talent, web designer, web developer. I mean, there was a phase there where, oh my God, I almost gave up because you could not get the technical talent. The people who are talented were not available, or you literally have to try and beg them to get on their schedule 9 months out. Is the technology. So in the early days of forcing, I would go learn the coding because I couldn't find the help or afford in really early days to get the help. And you're right. So I did do my due diligence. Though I would say though that it's like picking a good stock. It's some of the part of it was good thesis, but yet there was also some good luck. I got some good luck on the other side because you never know.
Yeah.
I mean, for myself, I had this thing about private equity because I was a consultant to private equity firms, and I did not like I did not like the guys that I worked for, but I feel like Leeds, who is the buyer here, is just a different, just totally my expectations about private equity were just a story based on my history. They don't really apply there. So in terms of the people that you end up with working with, you in my case, you get the benefits of some luck. You can only do so much due diligence, and then you probably had more choices than me, but you're much bigger. But appreciate that.
Yeah, the process was not difficult, but I didn't do all the legwork. You have a significant other in your business, and I have a significant other in my business who heads up operations, and it was a lot. It was a lot thrown at her in a very short period of time, and she did it all. Shielded me from a whole bunch of stuff that I would have otherwise had to deal with, which I'm not a details guy. I'm kind of a big picture guy. But what this does, going back to time, what this does is it clears out a whole bunch of stuff out of my schedule that I was doing that really didn't add a lot of value. That somebody else can add that value now, especially the administrative side, and don't even get me started on the IT bottleneck. You just simply couldn't find people. Simple as that. And it's even worse today. You simply just can't find people. So to learn that there was this huge IT pool that we could tap into was like, giving a thirsty man water. It's like, I'm in just for that. So it allows me a lot more time to do the value adding things, the things that I'm really good at, which is the video. So for our candidates, they can expect to see more applied series, more applied video showing up. They can expect to see more seminars. It gives me a chance to update some of the videos we have. Year to year, there's some content that never changes. You look at the reading and it's 100% exactly the same. But when I re-listen to it, I know that I can refresh it with current events, with current content, and tie it closer to the market. So I've always had this list of nice to do things. Well, now those nice to do things are actually a reality. I can take them off the shelf and say, my friends, I'm back. Let's get this done. So
well, and nobody does video like you. It's like that you like all week I've been reading about inverted yield curve, and then you're the first time you link it to relevance. You're the first one in a while. The best explanation I ever got to why an inverted yield curve matters. And you actually got me to worry about it because before I thought that was just a statistical thing, and I wasn't worried about the inverted yield. You explain that video, encourage people to see it, why the yield curve matters in terms of credibility, and then you even went on to mention capital adequacy, which is part of the FRM.
Yeah.
So it's like in a few minutes there, it's like everyone else, my Barron today is like inverted yield curve, and they never tell you why I should care. And now I suddenly do care about it. But the about video, Mark, that's obviously such a strong suit. I mean, there's a couple. One question for you is, do you think people have different learning styles, or why is it that all of your audience can? It seems like all of your audience can use video. Do they need? Do they not? Do you have learners who don't want to do video? They just want to do study notes, or they just want to do revision?
So this was a big thing for the last 10 years in academics, is is there was some literature in the education in the learning space talking about learning styles. That, you know, some people are tactile learners, some people are visual learners, some people you know, want to see something, some people want to read something. And it sounded refreshing that, oh yeah, that maybe that's an answer to why you have a distribution in your classroom of some people who do well and some people who don't, and why these people who don't do well in this class tend to do well in other classes. That sounds refreshing. So that started to be incorporated into curriculum, that rather than just have the traditional model, which is called Sage on a Stage, where you stand there with your PowerPoints and you just tell people what you know, that you would then start to incorporate a whole bunch of other things, like breaking people up into groups and having them talk with each other. Pair and share, which means you and I would turn to each other, and then I would teach you what we just heard, and then you would teach me what you just heard, to see if our understanding is right, to get more active learning. And a lot of research has been done on that, and the conclusion is no, there is no learning style. There is no, you may have a preference for a particular type of learning. Like, you may have a preference to say, I would rather read something than hear somebody read it to me. You may have a preference to say, I would rather be in a classroom with live interaction as opposed to watch a video. But a lot of research now is being done with control groups saying, we're going to teach you with this style, we're going to teach you with this style, and teach you with this style, with random people in each. No significant difference in the scores across those groups. It is the aptitude for learning that matters. And when you have the aptitude for learning that is distributed across a population, and you have a fixed number of hours in which to learn in, you will get a distribution of scores. But if you remove the hours and you say, take as long as you want and write the exam when you're ready, that distribution tightens up and moves up, that everybody does well. Because what might take me 1 hour to learn might take you 3. But if the class is only 1 hour long, then we have a quiz, you're not going to do very well, even though you're capable of learning it. It's just you have a slower speed to learn that stuff, but you could learn something else faster. And that's what got confused with this learning style business. Learning comes down to this, and I think a lot of people miss this altogether. If I tell you what I know, the thinking is you will now know what I know. But that's not learning, that's telling. Learning is me telling you how to know what I know. Then you don't need me anymore. Right? So now you know how I know what I know. That's learning. So the content that's in there is not as important as the process for how you get to know the content. So the pedagogy is far more important than the content. So when I see PowerPoints and lines on PowerPoints and people reading PowerPoints, I think you're missing the point. That's not teaching, that's telling. You're not telling me how to know this, you're just telling me what to know. And that's very different. It's the analogy of teach a man to fish as opposed to teach a person. Let's be inclusive. Teach a person to fish as opposed to give a person a fish. And I think that's what made the big difference, is that when people watched what I did, because I approached it from that perspective, that I'm gonna give you the secret so that you don't need me. I'm going to tell you how to know what I know. Nothing is as addicting as success. And success in learning is when you say, oh my God, I get it. Well, when you learn with that, you can't wait to get back to it, because what else can I learn now? If it's this easy to learn, what else can I learn? And it's the instructor's job to make it easy to learn. Too much of that is offloaded onto the student, where I'm going to tell you something, but the heavy lifting is really on you. And too many authors write chapters like this, where they write a chapter and you're left with, what? But hang on a second, you haven't really explained how I can know this. You've only explained what I should know. But I don't know, unless I already knew it, I don't understand half of what you're saying. So there are writers that know how to write for a learning audience, and there are writers who don't. And one of the problems I'm having with CFA content over the years is they've moved away from established writers to new writers that don't know how to write for a learning audience. So when you read their stuff, it's like, what's your point, man? Like, I can't figure out what point you're making, and you know your topic in such an incomplete way that I'm now frustrated. Right. You know, so it's I think that's what students were drawn to originally, because we didn't spend a single penny in advertising, and we got to the size we got to in, well, 6 short years. From the time we posted our first video on YouTube, everything was customer driven. Everything was, you know, can you do this? Can you do that? Can you add this? Can you add that? And it was just because, you know, I approached it and said, we're going to teach. We're not going to tell. We're going to teach. We're not going to assume anything. I'm going to give you all the building blocks. We're going to derive the formula, even if we don't have to, because once you see it derived, you'll realize that, oh, is that all that is? And it demystifies, and suddenly you say, duration is nothing more than the slope of a line. Oh, well, that's easy. Now you start to get what's going on with this PV plus minus PV minus over 2. That's just rise over run. It's just a sensitivity. It's just, I learned that in grade 9. This is nothing. Exactly. And suddenly now when you talk about duration, you can start to see that, you know, the curve, the convex relationship between price and yield. You can see that duration is nothing more than the slope of the line against that curve. That's all it is. You know, and it demystifies, it clears it up, and you think, this is not difficult at all. No, it doesn't have to be. But if I didn't teach, if I told you, then it's a little bit inaccessible. And when it's inaccessible, it's confusing. When it's confusing, it's frustrating. And now you have to push yourself to study, because it's not fun being frustrated, you know? So
what is video have any special advantage in showing, because you're still doing it's a lecture format, and
yeah.
by the way, you do long format, which sort of counter to the trend. You know, on YouTube they keep telling you shut it down, shorter. You can do an hour there on video. Does video have any special advantage over writing for achieving the kind of learning you're talking about?
Well, it does. I think, because sometimes you need to hear it in a different voice than your own voice. So sometimes you can read something abstract and say, I have no idea what you're talking about, because you can't bring it down to anything concrete. But then you can hear somebody else describe it in an abstract way, but they use different words to get it done. Or they'll draw a picture and suddenly it brings it down to earth for you, and you now have a structure to put on. You go, okay, now I see what's going on. There should be a comma here and a stress on that word, and the sentence reads much differently. So sometimes hearing somebody give you a definition of a word that you think you know, but when they give the definition, it adds a little bit more insight that you didn't have before. I liken it to poetry. You know, you can recite poetry, you can read poetry, or you can have the author read the poem, and suddenly it sounds so much different. And it's, you know, it's the same with Shakespeare. I watched Denzel Washington in Macbeth, and it was, if you really want to watch Shakespeare and not even feel like you're watching Shakespeare, Patrick Stewart, absolutely incredible. He brings it down to, he takes that and his interpretation, his stress, the way he moves his body and his facial expression. You don't need a translator for Shakespeare when he does it, because he does it so well. He does it just so great. And so much Shakespeare that you watch, sometimes you watch and you think, okay, I don't understand what you're saying because you're repeating the words, but I don't believe these words and I don't understand the words. But Patrick Stewart could say the same thing and you fully get it. And that's, I think, the difference between a good teacher and a poor teacher. Is a good teacher can say the very same thing the poor teacher is saying, but say it in such a way that you say, oh, is that it? So it has a lot to do with, how well you know it versus how well you can read it.
Yeah, great analogy. That's
Yeah.
real. I love that.
Yeah. So that was how long we've been doing this now. We're up to an hour, a little over an hour. We covered a lot, and
Yeah.
and I think we buried the headline a few times as well, right? So you know, just to give the high level view, we are now part of the same organization, you and I. I've joined Serify, which there you are. Many people over the years have asked me if I was ever going to do FRM, and it was all about bandwidth. There was no time to do bandwidth. So I'd always say just, you know, go to Bionic Turtle. They have a, you know, off you go. So I send a lot of people that way. Now we're side by side. And we have, I guess it's a new LMS that's being introduced that'll be rolled out over the next little while so that the experience, the user interface, the user experience with CFA is fully transportable to FRM because it's the same. It'll be this. I'm going ahead, jumping ahead and saying, well, if it's going to be a common LMS, we're going to have a common experience. That the menu items will be the same. Everything will be in the same place. You click on the same thing. You don't have to leave the site to pick up the second designation. You could do it right there on the same site using the same resources. You don't need to have two passwords and two different payment systems. Everything is all in one place. So there's no reason why those who are finished their level 2 CFA can't just walk across the hall, click on level 1 FRM and write that exam. And who knows,
Exactly.
maybe my voice might show up on your side and your voice might show up on my side.
I love it. I
Yeah.
love it. Yeah, that's going to be great. And then, yeah, just the power of the synergy there too, because we have a shared behind the scenes, a shared knowledge base, because there's so much in common.
Yeah.
And eventually, you know, I would think even like a skills graph, like they're doing at Coursera, so you can really give the learners their sort of a pathway through finance if they want to take different branches. Once they take FRM, if they want a CFA, they can you know, it's a central skills graph. I would think we could give a lot of insight. So it's a behind the scenes as well as a convenient front end.
Yeah. Yeah. And well, that wraps it up.
Okay.
That's all I got to say today.
Great. Well,
So that was
congratulations, Mark.
that was the dry run. Now let's do it again with the video on. Ah, look at you. I got you, eh? April Fools. A couple days late for April Fools, but I saw you sitting there going, "Oh, you got to be kidding me." You got to be kidding me.
Yeah, that's funny.
Yeah.
Thank you.